Hello and welcome to Season 2, Episode 1 of the Talking Central Banks podcast with me, Karan Marishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about how sovereign debt can shift from a shock absorber to a transmission channel, how global benchmarks themselves are being re-examined, and what that means not just for advanced economies, but for emerging and frontier markets as well. We will be exploring why restructurings are more complex today, how the creditor landscape has changed, and why understanding investor incentives and coordination problems is now essential for policymakers. Our guest tonight is Lupin Rehman, who is one of the world's leading experts on sovereign debt and emerging market economics. With more than 2.5 decades of experience across global financial markets, policy institutions, and asset management. Most recently, Lupin was the head of emerging markets sovereign credit and a member of the ESG leadership team at PIMCO. Previously, Lupin has held senior roles spanning sovereign credit portfolio management, macro research, debt sustainability, crisis resolution, and sustainable investing. She's worked at the IMF and the World Bank, helping shape global debt sustainability frameworks. Lupin holds a PhD in economics from the London School of Economics. Her new book, The Sovereign Debt Investor, brings all of her experiences together, offering a practical and insightful guide to understanding sovereign debt in a world of higher rates, rising debt, and more frequent shocks. Welcome to the show, Lupin.
Thanks very much, Karan. It's great to be here.
My pleasure. So first and foremost, Lupin, you've just published your book on sovereign debt this December, drawing on decades of experience across markets and policy. The topic feels more central than it has in decades. What prompted you to write this book now?
So thanks very much, Karan. I think, when we think about sovereign debt, the general tendency is to think of it as a very niche topic, mainly relegated for emerging markets or African countries that are facing debt crises and default. But as you note, that framing is actually quite outdated, and it no longer reflects the reality that sovereign debt plays in the global financial system today. Now, one thing that we've seen since the 2008 global financial crisis is that sovereign debt levels have risen across almost every major economy in the world for both advanced and emerging economies. So if you're looking at the US, public debt has climbed from about 65% of GDP to about 120% today. The UK, it's close to 100%. The Eurozone has a large discrepancy across countries. We're looking at an average of about 90%. And then we have China, where there is a massive, dramatic shift in government and quasi-government debt to close to 90% today. So sovereign debt today is not about one country or one region. And importantly, advanced economies are not immune from the risks that stem from high sovereign debt levels. So I wrote this book because essentially, a lot of the tools that we've used in emerging markets to assess sovereign credit risk are now much more applicable to advanced economies, essentially looking at how confidence in sovereign credit breaks, how politics and markets interact, how liquidity can dry up, how market technicals can impact pricing and returns. All of those aspects are now becoming much more relevant to developed economies as well as in emerging markets. So that was really the kind of the spirit behind the book. It's to bring the EM playbook to advanced economies.
So what kind of audiences you think would most benefit from this book, Lupin?
So the book is written for practitioners, so new investors in fixed income, given that sovereign debt is essentially the benchmark for fixed income markets and more broadly global financial markets. So new investors in the fixed income and sovereign debt space, also policy practitioners, because it is becoming much more important for policymakers, including central bankers and debt ministry officials, to understand how sovereign debt markets are working. So the audience is relatively broad. The book is very accessible in terms of how it talks about markets. And so it's really designed to help the beginner to understand what the key frictions and frameworks for the sovereign debt market are.
In this new context, Lupin, what does this mean in practice for how policymakers and market participants should think about sovereign risk and its role in today's financial system?
The key shift that I see is that sovereign debt is no longer a passive backdrop to the markets. It's actually an active transmission mechanism.
Right.
So if we take a step back, sovereign debt historically has acted as a shock absorber for the global system. It's essentially absorbed the impact of repeated crises that we've faced, the GFC, the pandemic, energy prices, geopolitical risks, largely because governments can borrow at low cost and they have the central bank behind the market. But today, essentially, we are seeing very different starting conditions. We have very high debt levels, tighter financial conditions, central banks stepping back, and that means that the framework has shifted. So essentially, the sovereign debt landscape is no longer simply a passive backdrop to the markets. It's increasingly a mechanism for transmitting risk across the market. And this becomes important because we are seeing a global financial system that is a lot more volatile in terms of the global backdrop, whether it's from geopolitics or simply from financial sector risks coming back into the foreground. So, what this means for policymakers is a mind shift change. So, historically, we've typically thought about sovereign debt levels in terms of ratios, in terms of debt sustainability targets and trajectories, especially in developed markets. Now, what we really need to do is move away from that mindset, from thinking about sovereign debt and sovereign risk as a stock or ratio, and instead view it as an active source of risk that can move markets, and that in
Right.
turn can shape policies.
Well, that's a compelling framework, Lupin. This prompts me to ask you, how are investors adjusting to these shifts? Also, where do you see pressures surfacing, and what should policymakers be paying attention to in how markets are responding at this time?
So I think investors are spending much more time on questions that they once reserved for emerging markets.
Yeah.
In advanced economies, looking at the Treasury market or looking at markets like Japan, the question now is becoming, who is the marginal buyer? What is the rollover profile looking like for debt issuance? How sensitive is fiscal policy to rates and growth trajectories? And in fact, how credible is fiscal policy? We saw a preview of that in the UK during the Liz Truss government and the fiscal repricing that we saw in the gilt curve during that time. But more broadly, these questions are being asked across advanced economies. There's also the question of what political capacity there is to adjust in terms of budgets and fiscal expenditures. Now, this is the wheelhouse of emerging market investors. This is the way that they've always assessed sovereign risk, even in investment grade countries, essentially by looking at the balance sheet first and then thinking about policy coordination, credibility, where sovereign stress can show up first and how confidence can break and how politics and markets interact. Now, in terms of policymakers, essentially, I think the question is to shift into thinking about these market-based risks that come through policies. So if you're looking at, say, central bankers, monetary policy is not only transmitted through policy rates and expectations, but increasingly through how the sovereign debt market actually functions. So thinking more deeply about term premia, volatility in the sovereign debt curve, in how correlations between different asset classes shift as sovereign risks get repriced. You've always had a link between sovereign stress and currencies in the emerging market world. This is becoming much more pertinent for advanced economies as well.
Right.
And it doesn't stop there. I think for fiscal authorities and debt management offices, there is also quite an active role to play. I think previously, at least in advanced economies, the focus has been on the issuance strategy. But now we are seeing that communication also matters a lot more than it used to. So, in this environment, effective fiscal and monetary coordination becomes really important. This is not about overstepping institutional mandates, but it's really understanding how policy actions interact from one part of the policy scope, whether it's central bank monetary policy making, to another, including fiscal credibility and debt issuance. So essentially, we are moving from just a very prescriptive policy role to a much more focused policy role in terms of thinking about markets and incorporating markets and the impact of policy on markets in core macro policy decisions. Now, I want to be very clear that I'm not saying that advanced economies are becoming emerging markets. I think sometimes there is a bit of a clickbait, analogy, but what I'm saying is that advanced economy sovereigns, and in particular policymakers, would benefit from thinking deeply about these interactions between policy credibility, markets, and the feedback loop between these three factors in terms of decision making.
So are there real world examples, Lupin, where these dynamics are playing out? Maybe you can point out to cases that help illustrate how high debt policy shifts and market reactions interact in practice.
So I think the difficulty is that there are no exact parallels. You know, Tolstoy in
Mm.
War and Peace said that every happy family is the same and every unhappy family is unhappy in different ways. And that's very true actually for
Yeah,
sovereign
yeah,
risk and also debt issues in sovereign markets.
right.
The example that academics and practitioners always look to is Japan. And Japan is useful for several reasons. It's not an exact replication of what we may see in, say, the US Treasury market or elsewhere, but it does bring out certain lessons. Essentially, in Japan, we had an advanced economy that has been operating with exceptionally high sovereign debt levels for an extremely long period of time, an unstable equilibrium or stable disequilibrium.
Right.
But essentially, what it shows us is a couple of things. First, that very high sovereign debt can remain stable for a long period of time when it's supported by strong institutions and deep domestic markets that have a bid for sovereign paper and a credible policy framework that can continue for the near to long to medium term. The second thing is that we can learn from Japan is that that stability is actually conditional and it can actually change when the underlying macro mix begins to shift. And we saw this
Right.
in Japan, not in terms of a rupture, but in terms of binding constraints coming from the fiscal side and essentially the rising interest rate and growth differential making debt trajectory much more sensitive to rates over time. And essentially, those are the two factors that we can see. When you have essentially a consistent marginal buyer, it can anchor the sovereign curve through yield curve control. And
Mm.
also, essentially, how markets shift as policies
Right.
shift include the impact that it has on the currency markets. And we saw that we're seeing this in Japan through higher volatility and a weaker yen. Now, as I mentioned, of course, the US is very different from Japan. It
Right.
benefits from deep capital markets. It has reserve currency status, exceptional institutional strength. So it's not a question of debt vulnerability in the traditional sense, but a matter of essentially, as we see less central bank balance sheet support, as we see the marginal buyer of US Treasuries move away or move elsewhere, as we see a bid for other assets like gold or even crypto, how does that affect the technicals related to the US Treasury curve? Do we have the need for an increased term premium, volatility premium, which should be embedded into the US curve? I think all of those questions become very pertinent when we're thinking about assessing advanced economies. And I think that, these are factors that historically we haven't really put that much weight in. It's always been in the background, but now these factors are coming into the forefront of how investors and policymakers are thinking about the US market.
A bit out of context here, Lupin, but I was just wondering, based on the response that you just gave, how do you think would the carry trades be impacted given the rate trajectory in Japan evolving right now?
So I think that, we've seen a shift in the carry trade. And I think that essentially, one thing I think is, how is the funding basket of currency trades going to change over
Right,
time? And it seems quite clear that there should be a shift from the yen essentially being the funder of these baskets to perhaps the US dollar, because there is a scope for the US dollar to weaken further, just given what we're seeing in terms of rate actions. So in a sense, this is not necessarily a structural play. I think that it's too early to call for a structural shift in the carry trades that we're seeing. But essentially, on the margin, we should be seeing, a bit more weakness in the US dollar going
right.
forward.
Coming back to the previous response, Lupin, raises the question of what all this means for emerging markets, with higher US rates, tighter global financial conditions, and greater volatility at the core. How are you thinking about sovereign risks and monetary policy dynamics in the emerging markets today?
So emerging markets have fared relatively well in the last couple of years, and we see this in terms of the returns that emerging local markets in particular have experienced, but also throughout the other parts of the asset spectrum. But one thing that is quite important in the current environment, much more so than in previous cycles, is that emerging markets are not a monolith. And in fact, the divergence across emerging markets is much greater today than it was in previous cycles. So essentially, what we're seeing is, if you think about any emerging market, tends to be driven by global factors, including, say, the US real rates, the dollar, global risk appetite. You also have global geopolitics, whether you are China centric or US centric or European centric, as a kind of a more structural driver of longer term returns. And then you also have an element which is more idiosyncratic to EM sovereigns in particular, right? So anything
Right.
related to local politics, any shifts in geopolitics that may affect a given EM sovereign. What we're seeing right now is that these global factors are now amplifying these differences between emerging markets. And essentially, markets are discriminating and essentially trying to pick winners across not only countries, but going down to even sectoral levels and asset pricing, given how much we've seen the run up in valuations. So that's one factor. The other factor that we're seeing is that it dovetails into this shift in trading away from EM as just a beta play to EM as becoming much more of an alpha play by country selection or sector or asset class selection. The other side of the coin for emerging markets is frontier and high risk sovereigns. And the picture there is very different. So, higher global real rates does have a much more direct and potentially destabilizing impact in many of these countries. Many of them face much tighter external financing conditions. They tend to have limited access to local currency markets. They also have higher near-term financing needs over the next 5 to 10 years as a result of borrowing previously in the previous decade. So for these countries, the rollover risk are increasing. The debt servicing costs are also increasing, and the kind of the investor bias towards investing in these economies is also facing a key challenge, which is, if we're seeing higher real rates across many segments of the advanced economy fixed income markets, what is the compelling reason to go into high yield frontier risk, which is much more illiquid, tends to have much more idiosyncratic risks that need to be monitored. It's much more harder to monitor, for example. So I think that for these set of countries, the kind of outlook is very, very different. But so for EM, I would say it's not just a one story fits all. Now, the interesting thing when looking at the bid for EM assets in general is that for many global investors, so crossover investors, not dedicated investors, emerging markets is also serving as a diversification play. So away from perhaps, higher tech valuations in the US or other advanced economies where the structural underpinnings of the fundamentals suggest that perhaps EM would be a better play. So that diversification play is happening. And it's an interesting driver to see the flows coming into the EM asset class because of that.
Right. You mentioned, Lupin, that for frontier and high yield emerging markets, higher global rates really compress the margin for error and make restructuring risks much more acute. One part of your book that I found particularly useful was how you walk through sovereign restructurings, especially the role of the various actors, including the official sector and bilaterals, such as China playing as creator. Could you elaborate on that and explain how China's presence affects the dynamics of sovereign restructuring in today's economic landscape?
So the starting point for any discussion when it comes to sovereign restructurings is to recognize that sovereigns are very different fundamentally from corporates. There's no bankruptcy code for sovereigns. There is no court that can impose an outcome and compel a sovereign entity to accept that outcome. So, what that means is that sovereign debt restructurings are inherently political. They are negotiated between the creditor and the borrower, and they involve many different players with very different objectives. So this makes sovereign restructurings inherently complex. And, essentially, they're not technical exercises built on profit and loss. They're actually coordination problems. So in any restructuring, you have several actors at the table. You'll have the sovereign itself, you have private creditors, whether it's bondholders or banks, asset managers with very different risk tolerances. You also have domestic creditors like local pension funds and local banks whose treatment has real financial stability implications. And then you have the official sector. And the official sector can be broken into the bilateral sector, so country to country lenders and country to country borrowing, and then the international financial institutions. So very different actors with different objectives, incentives, and time horizons. And essentially, this is where it becomes important for policymakers to understand how investors think about sovereign defaults and their decision making in sovereign restructurings. There are two things here that I'd like to highlight. The first thing is for investors, the P&L of their portfolio is typically impacted well before a sovereign actually defaults, and when it starts to restructure, which is typically, several months after defaulting. If the restructuring is a result of an actual payment default. You also have restructurings that are pre-default, so that it's preemptive. But essentially, markets tend to price sovereign risk relatively quickly. And so for investors, that hit to P&L happens well in advance of any restructuring talks. So the actual talk itself is essentially an exercise in assessing the restructuring proposal, trying to get the kind of coordination part of the solution over and done with. Now, of course, an investor has a fiduciary responsibility to its clients. So it looks at the restructuring proposal and accepts it or rejects it depending on their own expectations of recovery, the timing of that recovery, the legal risk, the credibility of the policy adjustment that the sovereign is committing to, and essentially, how the market itself is positioned in that sovereign risk. So there are many, many factors, but it's important to recognize that, a lot of the impact for investors already happens well before the restructuring. The second factor that's also important for policymakers to recognize is that investors aren't necessarily vulture funds. So I think with the Argentina saga that happened with the Argentina default, essentially, investors are often painted with this brush that they're all vulture funds. I think it's important to recognize that in the vast majority of sovereign debt restructurings, investors tend to be real money. And also, they tend to come from very different segments. So they could be part of the domestic banking sector. They could be part of the domestic pension fund. Real money from an international perspective could also be sovereign wealth funds, institutions with mandates like insurance mandates, which are long term. And their incentive is to get the sovereign debt restructuring done efficiently and fairly, and essentially not really go into a prolonged legal battle. So it's important for policymakers to recognize these two aspects when thinking about restructurings from an investor perspective. Essentially, right now, the sovereign debt restructuring landscape is not a matter of private sector coordination, because essentially with the introduction of the various generation of collective action clauses, we've essentially seen not a complete solution, but almost a significant shift in how sovereign debt restructurings are resolved when it comes to holdout issues in the private creditors landscape. What is different now is that really we're facing an official sector coordination challenge. We've seen the growth of bilateral lenders like China and the Middle East becoming a major creditor to many developing and frontier economies, and naturally they are asking questions about the rules of the game. These rules evolved under the Paris Club and the IMF-led framework for sovereign debt restructurings, and these are being actively debated. So questions like, how should domestic creditors be treated? When should they be bailed in? Concepts like comparability of treatment, how should that be interpreted? Even questions of the seniority of official sector debt, and whether they should continue to be senior if they're not giving additional funding for the sovereign. So all these questions are coming up. What I think is important to stress is that first of all, this is not a China problem. It's an official sector coordination problem. And it's a world where we are seeing new questions being raised because there are new entrants to the creditor base. The second thing is to recognize that there actually has been real progress since the COVID pandemic and the debt restructurings that we've seen in some of the recent countries. Essentially, we are seeing a greater willingness to have the private sector being bailed in through the use of collective active action clauses. We're also seeing more innovation around instruments that provide two-way debt relief. We saw that in Sri Lanka's case. These offer upside when growth recovers, not just downside protection for creditors. We're also seeing separate initiatives like the Bridgetown Initiative, which are introducing contingent liability type of clauses within sovereign debt contracts, which are also quite important for countries that are facing climate risk or risk of downside risks of downsides in their ability to repay debt due to unforeseen circumstances. So there's a lot that is happening that is new, and there's been a lot of progress. There's still challenges for sure, but essentially, I think that this part of the sovereign debt landscape is going to continue to be an important part of the dialogue between policymakers and investors.
I was talking to one of the emerging markets deputy governor, one of the emerging market central banks deputy governor, and he was telling me, Lupin, that loans from China have a very quick turnaround, and therefore a lot of emerging markets actually prefer Chinese loans as compared to multilateral or other bilateral agencies, because they have countless technical missions before they actually, go ahead with those loans. But at the same time, the problem that we've seen is that most of these Chinese loans are tied to collaterals which include strategic assets in those sovereigns. So, how do you see this having implications on sovereign debt restructurings in the near term? Because it is quite different to how the Paris Club operated, for instance.
So there are many things to unpack here, right? And this is not about only China being the supplier of the loans and the loans being tied to strategic or geopolitical assets. Because, if we take a step back, most bilateral lending has that element of either strategic lending for historical reasons or to have access to strategic assets like ports or strategic infrastructure. So I don't think this is necessarily, a China-only issue. But you're right that, essentially the quid pro quo for much of this bilateral lending, it has a geopolitical element. The other element really is, you're talking about turnover times. That's true for loans in general. It really boils down to the issue of institutions, right? So what we've seen in the last 2 decades in many frontier economies is that they have not been able to absorb the financing that's available from the larger IFIs or the advanced economy bilaterals because of the various conditionalities that are included. And the Chinese option is a much faster route, especially in a world where perhaps you need access to financing because you're getting squeezed for many different reasons. So the issue really comes down with the country level institutions. Are there checks and balances to ensure that this debt is the right debt, that is transparent, that is being priced efficiently? Is essentially this debt being recorded as the sovereign liability, or is it kind of part of the off sovereign balance sheet because it's coming through quasi entities or even private sector entities that have the implicit support of the sovereign? And then the other element really is, to what extent is this debt actually being disclosed in official numbers? Now, with the IMF data transparency initiatives, there is a commitment for sovereigns to essentially report this in the total debt numbers, but often you're not getting the kind of more detailed information about the terms, the actual tenor, exactly whether there are any other hidden contingencies in these debt contracts. There has been progress on this. We saw that with the Pakistan program a couple of years ago, where there was a push towards greater debt transparency. And so it's a work in progress. So the question really is, for me, it's whether the debt is being, cited or adequately vetted in terms of the return profile given the cost, and also whether the country itself can afford that debt, whether the country's overall debt burden is being sustained, and whether this is actually, part of a broader debt strategy rather than, it being an issue because it's Chinese funded or not Chinese funded. I don't think one type of debt is better than the other. It really is coming from the kind of framework perspective to see whether the debt is a positive debt for the economy as a whole.
Very interesting, Lupin. In one of the more forward-looking parts of your book, you devote a chapter to digitization and innovations in the sovereign debt space. Why was it important for you to include this, and what should policymakers and market participants really take away from this perspective?
So the chapter on digitization and the use of new technology in the sovereign debt infrastructure space is really essentially focusing on how the issuance and the plumbing of sovereign debt markets is changing. And essentially, the new technologies that are coming about really can shift how sovereign bonds are issued, traded, and settled. And if you're looking at it from a very basic perspective, these technologies can make sovereign debt markets, particularly across the world, much more transparent, much more efficient. It can make issuance quicker, settlement can be faster, custody can be much more clearer, but they also raise questions about regulation, the kind of stability of market infrastructure, and how quickly different participants can actually adopt to the new technology. So,
Right.
let's take blockchain specifically. This opens the door to digital or tokenized sovereign bonds. So instead of relying on long settlement chains, bonds can be issued as digital tokens and ownership can be recorded transparently. Settlement can happen much more quickly. You can have smart contracts that automate coupon payments and redemptions, all of which reduces operational risk. And then also you have the knock-on effects in terms of lower administrative costs and so on and so forth. You also have shifts if you're thinking about tokenization, which can change who can participate in sovereign debt markets. And this is really important for emerging markets in particular. So by allowing fractional ownership, it lowers the minimum investment size that has typically been quite high for entrant into this field. And this can bring forward a whole new set of investors, particularly retail investors and smaller institutions that previously couldn't market or access this market directly. And over time, this should support liquidity and diversify the investor base. So essentially, this part of the sovereign debt market is undergoing transformation, and it's important for us as investors and policymakers to think about how this shift in technology can be used not just for disruption, but really to see how the design of sovereign debt markets can be improved. Now, what we're seeing right now is, there are a lot of pilot cases going on, and most sovereigns are prioritizing digitization of infrastructure. And essentially, what they're looking at is trying to see, whether you can also have, greater legal certainty and central bank compatibility within the current constraints of the current system. We're also seeing tokenization being tested for, things like settlement efficiency, transparency, and broader investor access, like retail. But essentially, the bottom line is sovereigns are digitizing cautiously. They're starting with the plumbing. They're not kind of going full on out, but it is underway. And it's important for us as policymakers and investors to really keep an eye on where this market can go.
Right. The infrastructure perspective is really helpful, Lupin. The book also devotes a chapter on sustainable investing and ESG in sovereign debt, and you did touch upon this point in your previous responses. This is an area where risk assessment, market incentives, and debt sustainability increasingly intersect. So, what are the key takeaways, Lupin, and how should policymakers, investors think about sustainability in the context of sovereign risk, in your opinion?
So sustainability has really moved from, the margins of investing to the center of how sovereign risk is being assessed and priced. And it's no longer just a values-based overlay, it's actually about sovereign credit and sovereign resilience. So the
Right.
question that people are trying to answer is, can a country generate enough growth? Can it absorb shocks? Can it maintain social and political cohesiveness over time? And so when you look at sustainability from that lens, things like climate exposure, demographic shifts, inequality, institutional quality, they stop being abstract. They translate into very real fiscal pressures, into contingent liabilities that the sovereign balance sheet would need to meet, and growth and social stability risks. So this in turn affects how much a country needs to issue and ultimately market confidence. So, the book goes through the various types of sustainable investing approaches because SI doesn't mean the same thing to everybody. But it really does spend quite a lot of time focusing on sustainable investing as a risk tool, not a values-based labeling exercise. And what that means is looking at the impact of things like climate adaptation, energy security, social stability, in terms of how they impact fiscal and monetary balance sheets. It's not just thinking about them as a nice to have, it's thinking about it as how they affect the kind of risks, the macro risks that sovereigns face and are likely to face over the next 5, 10, 15, 20 years. So it's important to think about that complexity. In many parts of the world, we are seeing, central bank and financial sector regulators asking asset managers to look at how their portfolios respond to various types of risks, whether it's overheating risk, physical risks, or due to climate change, or energy security risks. And essentially, this has real effects in terms of portfolio returns. And it means that investors are also having to build out tools to understand how these varying types of risks affect their portfolios. So this chapter really is trying to look at how to think about that. It's a very broad chapter. There are so many elements of thinking about sustainable investing and ESG risks when we were trying to incorporate it into traditional credit risk analysis and portfolio construction. So, essentially it guides the reader through various elements of this kind of new part and new and very evolving part of investing. The other thing that's also important to flag is there's a regulatory layer that is becoming more and more important, both for policymakers and regulators and investors. Essentially, what we're seeing is different jurisdictions are setting rules around what qualifies as sustainable investing. They are setting rules around fund mandates, disclosure, capital allocation, and this affects both investors and issuers. Essentially, it requires a whole new set of rules and frameworks for investors and issuers to adhere to, which weren't there, a couple of decades ago. So it's a very important and integral part. It's a part of the fixed income investing landscape that doesn't seem to be going anywhere anytime soon. It's only going to grow. And so it's important for any practitioner to understand how to think about sustainable investing within that framework.
Very interesting, Lupin. Speaking of which, what has come through very clearly is that sovereign debt is no longer a narrow technical topic, and apparently sits right at the center of how markets, policy, and politics interact. Is that the right way of thinking, Lupin?
I think so. I think that, sovereign debt is just no longer a niche asset class. It really should be we should really be thinking about the sovereign debt markets as a key risk transmission mechanism for the global financial system, and essentially how shifts in sovereign credit worthiness can affect that global financial infrastructure. I think that's the way that we should be thinking about sovereign risk going forward.
As per IMF's projections, Lupin, global public debt is likely to reach 100% by 29, which is
Mhm.
the highest level since 1948. How do you see this situation panning out, and what kind of implications do you see on the global economy as we speak?
So the headline number is striking. And I think, what we should do is really think about how we should interpret that number. So 100% of GDP is not a magic line in the sand that is, telling us that there's going to be an imminent debt crisis. What is important is to understand essentially the reason why we have got to the stage that we are and how things can look going forward. So, if we take a step back, this growth in global public debt ratios really has happened because sovereign balance sheets have been used to absorb historic financial crises. And this has meant that there has been a shift of leverage from the private sector onto the public sector balance sheet. And this has really accelerated since the great financial crisis of 2008 and the pandemic. But essentially, that mirroring of higher public debt ratios is an important factor that is often overlooked, in that higher debt ratios on the public side also mirror a more resilient private sector balance sheet, so more resilient banking system and less leveraged households than would have otherwise happened if the counterfactual didn't exist, right? So we have to really think about the two together. And the real issue is not the level of debt per se. 100% seems very high, but we've seen also cases of many large sovereigns, advanced economy sovereigns, surviving for quite a long time with high levels of debt. What's important is the interaction between debt, growth, interest rates, policy credibility, and a belief of the market in the confidence of the system. So we know that high debt can be sustainable when growth is growing, when financing is stable, when you have credible policy frameworks, but it becomes problematic when any one of these pillars start to become a lot more shaky. So, refinancing risks become a key factor. The interest growth differential is also a key factor when we're looking at debt sustainability, and then market confidence. What is different about this period than from the past is that we are also transitioning from an era of ultra low rates, right? So it's not just a regular business cycle. We've just had a period of very significantly low rates and central bank balance sheet support, which is moving away. And this means that debt sustainability and policy credibility will be tested much more in the market. When, as I mentioned before, when the marginal buyer of debt is shifting hands, you do expect to see a bit more term premium, a bit more volatility that has to be priced into the sovereign debt curve. So, I don't see this as as a signal of just an imminent global debt crisis, but I do see it as a regime shift. Sovereign debt is not a passive benchmark anymore. It's an active variable. It's shaping markets. It's shaping how market respondents are thinking about risk return. And it also raises the bar for policymakers because we need more fiscal credibility, better debt management, better policy coordination across governments. It becomes much more important on the margin than it has been in the past.
The fundamental difference, Lupin, in today's time is that the trouble is with the advanced economies like the UK and France. And there were talks that they might be looking at bailout from the IMF. How do you see this situation? Because we never really saw the G7 members actually going on that road previously.
So So we've seen the UK, but this was in the 70s, right? So it's not
Right.
necessarily a situation that hasn't happened before. Ultimately, the question really is, there is a lender of last resort, and that's usually through the multilateral organizations. It's a matter of whether the locals, the citizens of these economies are willing to take the tough actions that need to be taken for policy to become credible. And so this playbook is something that we've seen in EM and also in some developed markets, right? We've seen the Eurozone crisis and how credibility was really only fostered when you had the troika essentially coming in with very, very large bailout packages and a policy credibility floor that was given by the ECB. So, I don't think that this is something that is new. It's just something that we're not necessarily used to in the contemporary period. And, this is one of the things that strikes me is that, many market participants today are approaching these issues for the first time. Um, Whereas, if you're looking at longer cycles, we have seen similar types of events playing out in previous cycles. So I think that, one of the reasons also for writing this book is to bring some of that knowledge, that historic knowledge to the fore into thinking about what are the winners and losers across countries? How should IMF bailout packages, what
Right.
are the reasons why they work and what are the reasons that they don't work? What have we seen in the past that may work or may not work in today's markets? I think every crisis is different, but it's interesting to actually bring forward some of those lessons that we've learned from emerging markets now to these advanced economies.
Well, that normalizes it. Due to the growing global political instability, Lupin, many countries are forced to spend more on defense budgets, and therefore budget cuts are unlikely, putting debt sustainability and effective debt management at risk. Do you think the debt to GDP ratio may rise further in this reality and bring about more volatility in the system?
So I think that higher defense spending is not discretionary in the usual sense, right? In a more fragmented, more unstable geopolitical environment, governments actually are seeing it as essential for national security, which means that large offsetting budget cuts elsewhere is going to be extremely politically and practically difficult. So, this is also at a time when you have rising inequality and a significant pressure for social spending, which is also increasing. So, I don't think that higher defense spending automatically implies an unsustainable debt path. You could have higher debt ratios in the interim, but what matters really is whether governments can combine these higher spending needs with credible medium-term fiscal plans. And there are many ways to get to that, right? You could have growth enhancing investments, you can reassess tax capacity, you can reprioritize spending needs over time. You could have much more realistic assumptions about financing conditions. So the real risk is not spending in and of itself, but the erosion of fiscal credibility. And the countries that are able to anchor their policy credibility are the ones that are essentially going to not be tested by the markets or the bond vigilantes versus the others where there is no real strategy for the medium term fiscal and debt management approach. So, I think that it's not necessarily that we need to have a doomsday forecast that there's just going to be high debt ratios ad infinitum, but really we have to distinguish between countries where we're going to see better policy anchoring and credibility and a better financing plan for this increase in spending, not just headline numbers. And I think markets are going to test policymakers in many different ways on these factors. The budgets of the advanced economies are going to be much, much more closely and much more examined in much more granularity than they have done in previous cycles. And that is something that I think is going to be here to stay.
Right. Finally, Lupin, going by the recent trends, it seems that the foreign holding of US sovereign bonds has increased from 5% in 1970 to about 32% in 2025. Nevertheless, in recent news, major investors such as Japan, UK, and China are reducing their holdings of this asset class. Moreover, US federal debt is already at around 120% and is likely to exceed 140% by 34, as per JP Morgan estimates. How do you see the global sovereign debt market evolve from here, Lupin? This is actually in the context of global central banks increasingly preferring gold over US Treasury as reserve assets at this time.
So I would frame this less as a sudden loss of confidence and
Yeah,
more as a gradual rebalancing. And this is a rebalancing of the global sovereign debt ecosystem. Now, it's true that if you're looking at it over the last couple of decades, foreign holdings of US treasuries grew structurally, which reflected globalization, reserve accumulation, the central role of the dollar-based system, and you've had, more recently, large holders like China reducing their holdings on the margin. But these reductions reflect a, a mix of various factors. You have the domestic balance sheet needs, you have FX intervention needs, reserve diversification, you've had also relative return considerations. It's not necessarily a wholesale exit from treasuries. In a sense, when the whole world is owning treasuries, you're not going to be able to just have a fire sale of them. But the shift is important, and it's important because we are essentially seeing that price insensitive buyers like sovereign wealth funds or central banks are stepping back, and the ownership of the treasury paper is basically relying on more price sensitive private demand. And that means that essentially you're going to get back to market behavior being much more important. It's the themes that we discussed before, that we will see term premium matter more. We'll see the issuance strategy mattering more. We'll also see potential volatility increasing and being more persistent. Now, for reserve managers, I think adding gold, regional currencies, and other assets makes a lot of sense. They're diversifying incrementally, and we've seen this over the last couple of decades as well. We've seen that shift from the focus on the US dollar to a broader basket of advanced economy currencies. Now we're seeing a shift also to gold, but gold plays a very different role. It's not necessarily a substitute for treasuries in terms of liquidity or collateral, but it's a hedge, right? It's a hedge against geopolitical fragmentation and some of these other risks associated with sanctions risk, for example. But that said, there is no realistic alternative to US treasuries as the core global benchmark. The depth, the liquidity, the legal framework, market infrastructure of the treasury market remains unmatched. So even with higher debt levels, the issue is not a solvency issue, but a liquidity issue. How
right.
volatility, market technicals, auction dynamics affect price as supply increases. Essentially, we are seeing a return of the bond vigilantes. And so all of the factors that I mentioned previously in terms of policy credibility and anchoring and thinking about debt sustainability, all of that will become more and more important. So, I think that I really don't see this as a rupture, much more an evolution. The treasury market remains the anchor for the system, but it's not insulated from market discipline. And that in and of itself is something that should bring you some confidence in that, when you have a self-calibrating system, then you can't really go too far in terms of unsustainable debt dynamics as you're referring to.
I often get confused about this aspect, Lupin, that liquidity shortfall is always the problem preceding any financial crisis. Even the GFC had liquidity situation impacting the big banks, including Lehman. And then even the dot-com bubble had the same problem, even though it did not have the implications that the GFC had on the financial system. But it always seems that before any financial crisis, liquidity is a problem. And most analysts suggest that it is just a liquidity problem and it's not a structural problem. So, how do you think this is different this time?
So not all liquidity issues are structural issues. And I think, we have to distinguish between what is a canary in the coal mine and what is just market technicals, right? So I think that, when you're looking at, let's take the kind of the example in emerging markets, when you're looking at, say, failed auctions, or you're seeing a sharp increase in short-term money market rates, all of those are usually a sign, if they have fiscal underpinnings, of a broader debt issue. But this is where policy comes into play, right? You can have short-term liquidity factors, but you may not necessarily have a solvency issue if the longer term sustainability of your debt and fiscal path is still credible, right? But you can have a short-term liquidity factor based on market technicals. If it is a liquidity issue, policymakers have a role to step in and either, conduct buyback auctions or step in with other liquidity management tools for the system. I think every single case is really, really different. And being able to distinguish the two is difficult in real time, because sometimes a liquidity issue can result in a solvency issue. So it may not
Right.
necessarily be that a solvency issue is driving the liquidity factor, but often sometimes we can often see a liquidity issue resulting in a solvency issue because, for example, it leads to structurally high interest rates, which then have a feed-through effect on debt sustainability. So I think that the question really is, what is driving the liquidity factor? Does it have further legs? Is this a canary in the coal mine or a market technical issue? And how are policymakers responding to it? Do they have the levers needed to respond to it adequately, or is it something that will result in a more structural repricing in the market, which will then have a feed-through effect on more solvency variables, which are important for the medium term of the economy?
Mm. Very insightful discussion indeed, Lupin. It's incredible to get a glimpse of your decades of experience across markets and policy, and bringing lessons from emerging market crisis to the entire sovereign universe. Rare to find that kind of perspective brought together so clearly. On that note, that's all I have for today. Thank you once again for the time, Lupin.
Thank you so much, Karan. I've really enjoyed our discussion. Your questions have been very precise and lucid, and I think that they've given me a lot of food for thought as well. So thanks very much.
You're very welcome, Lupin.